All right, so we've been getting, and I've been getting a ton of questions really as it pertains to the real estate market as a whole. I can't find myself out on the golf course or in one of our local restaurants without somebody asking me about what the current real estate market looks like. And we've been getting a ton of questions from current clients, current investors, and really prospect investors around what the current market in economic cycle looks like, where we are with equities market, what should people be focusing on right now, how are we finding good real estate deals. We're going to kind of go through and break all that down today. So I've got on here the Ty Lasater, founder and CEO of Lasater Capital. Joining myself and co-founder Boone Lasater and CFO is our managing director, Brian Robb. And so each of us bring really a dynamic experience level to our organization. Brian, through years in their traditional market cycle and traditional markets and equities, along with a number of alternative platforms. I'll let him give a brief introduction to his background, but then my focus as it pertains to real estate and implementing our strategies within the real estate sectors that we focus on, and Boone bringing his financial and accounting background into that and really implementing that into the business strategies that we have. But before we get started, real quick, Brian, why don't you jump in and give a little bit of background about yourself?
Yeah, thank you, Ty. Great to be here, everyone. Again, Brian Robb, Managing Director. Several decades of experience in the financial services market. Worked primarily with large institutions, but more recently with high net worth individuals in the alternative space, and worked with big organizations, governmental entities, nonprofit organizations, endowments, foundations, family offices around financial planning needs, both in traditional markets as well as public markets. I have probably more FINRA licenses than I care to mention, but quite a few in the industry. And it's great to be here. I really appreciate the opportunity to be on with both of you today.
And I think if there's a license there, you have it. So I think
Right.
that brings, just a wealth of opportunity and knowledge to our company that we're excited to have. But more importantly, it brings your experience and really correlating different types of investments to what it is that we do. And as I'm sure you're all aware, and Brian, as you've pointed out, that you really when there's pressure in one specific sector of the marketplace, it creates opportunity and or chaos in other aspects. And so, what we've been seeing right now in the financial market with equities trading at large multiples above book value, it's creating some opportunity in other asset classes, but it also oftentimes what we see is we see maybe non-professional investors that get glamored by the rise in the equities and they start buying more instead of positioning their portfolio to start taking chips off the table when there's a large rise in the equities market, and start focusing on some other counter correlated opportunities, which is what we're going to talk about today. So, one of the big things that we see is when Wall Street gets really, really expensive, real assets, physical assets, assets that have a physical aspect supporting their valuation get really interesting. So why is it that overvaluation in the equities market creates opportunities in the private markets, do you think, Brian?
Yeah, I mean, if you go back 100 years or so and you look at the price earnings of the market, you typically find a pretty clear indicator. When you have record high price earnings ratios, it's almost a clear indicator that you're going to have some sort of correction after the fact. These markets have been interesting the past couple of years, but if you look at the heads of JP Morgan, Goldman Sachs, some of these large banks, a lot of them agree that the market is very highly valued. Our traditional, call it trailing 12-month PE ratios sit at currently about 30 right now. Probably a more accurate number is the cyclically adjusted price earnings ratio, which is more in the tune of about 39 to 40. Now, to give you some context, typically we see markets trade anywhere from 10 to 20. So from all indicators, we are 2 to 5 times higher than traditional earnings would indicate. The real interesting thing that we've seen is If you look at the market capitalization of the S&P, as a lot of us probably know, it's dominated by the big high tech firms, the NVIDIAs, the Microsofts, the Apples. And then if you look at the price earnings specifically for those companies, I was just looking at this yesterday. NVIDIA is currently at a little over 45 price earnings, Apple 37, Alphabet 31.8, Microsoft 34. Tesla's kind of an interesting. Tesla's trading at 304 currently multiple on their price earnings. So we have seen record highs as it relates to the earnings. Now, that indicates a couple of things. There's intrinsic value in stocks, which obviously is what value does the actual performance generate. And then there's what I would call extrinsic value or perceived value in the stock. There's a reason why Tesla board just approved a $1 trillion pay package for Elon Musk. And that's because of the extrinsic value they think that he brings, even with the change in the EV mandates and the tax credits that we've seen go away with the big, beautiful bill. There is some perceived value in making sure that he stays on. And so that can also impact valuations in the market. But the moral of the story is we are very overly high as it relates to the price earnings ratios, historic, as you look at the market as a whole. And so all indications are that can't last forever. Very heavily weighted towards high tech stocks, and those high tech stocks make up a huge percentage market cap wise of the overall S&P.
You brought up a good point, Brian, that I wasn't intended to go into really, but I think it's a really good point in this. And then I'll kind of get back on topic. But you brought up the extrinsic value, and I think it's interesting that you look, especially as we're seeing a transition in the marketplace, more the Gen Zers kind of stepping in and really with the growth of social media over the last couple of decades, and we're seeing CEOs, company leaders start building a more personal profile. And it's bringing that extrinsic value to the marketplace. And so, Tesla doesn't have Elon Musk, and we're talking about a very significant different valuation than what they have today. And it's oftentimes said in small businesses and in private businesses that up until you do your first $10 million in revenue, buyers and clients are buying you, the person. But I think we're seeing that grow now, and that's coming into the same place with large publicly traded companies and CEOs and the like. And we're seeing more and more of the faces of the organization. You've got the CEO getting more and more involved. In fact, I saw an advertisement during one of the games last night where the new CEO of a restaurant company was on the advertisement. He was the face of the advertisement, which we haven't seen in years. So, maybe step in, Boone. I want to hear your background and your thought in this. Brian, I want to hear kind of what your thought is before we move on.
Yeah, great to be here. Happy to see everybody. I'm Boone Lasater. I'm founder and CFO here at Lasater Capital. I bring a background of working in the public markets for some time in both financial preparation, audit, and tax work. So yeah, I think this is a definitely interesting time that we're seeing in the market right now. Brian, you bring up some good points of the overvaluations we're seeing. We've obviously seen valuations like this in the past, and it's obviously time for a correction. This is typically a time where we've seen some type of bubble happen, whether it be tech, whether it be real estate, or whatever. And so there does come a time to where you have to look at your portfolio and see if you're overweighted in a certain asset class, and if it's time to reevaluate yourself and your holdings and see if there's a better way to spread your chips across the table.
So,
Yeah.
with that, Brian, what kind of walk me through what you're seeing with that extrinsic valuation across the equities market, but then correlate that into private businesses and how, businesses like ourselves where the founders may have a role in the sales process or have a role in the acquisitions process, much like I do, where I'm involved in targeting the assets that we're acquiring. How does that correlate though into the Fortune 500s or the S&P 500, where we're seeing more and more CEOs as the face of the company and having more active involvement and or creating an aspect of the price multiple on their stock?
Yeah, I mean, it's a double-edged sword. 10 years ago, 15 or 20 years ago, before social media, when investors did research on companies, they might go to Morningstar, Bloomberg, and they'll look at the financials, they'll look at the analyst reports and make decisions based on data. So much of what people are looking at now are, if any of us who have kids know that they're active on TikTok and social media or X or Twitter or some of these other platforms. So you have to be very careful. If you're considered a company insider, you have to be very cautious about what you actually post out there. But people do read between the tea leaves. And when there are posts by Jamie Dimon and others that make references to where he or she feels like the market is headed, people take notice of that, and it acts very quickly. There's something called the efficient market theory, which basically says if you've identified some opportunity in the market, that's already built in to the stock price. And that was relatively easy 10 or 15 years ago. I would say today, if you identify, hey, there might be an opportunity with a particular equity because the CEO is going to make some comments, by the time those comments are made, it's already built into the stock price. So things move very, very quickly today. And I would say that's even exacerbated more so by some of these high tech companies that own some of these platforms that are actually
Yeah.
out there promoting some of the news that they're seeing. And it's information. Investors have access to much, much more information than they used to 5 or 10 years ago, and they're acting on that. So again, that can be good or that can be bad. Warren Buffett has a famous saying that the stock market is a mechanism for transferring wealth from the impatient to the patient. And people that look at social media can sometimes be very impatient, as you can imagine. And so it's really about understanding the fundamentals, sticking to the fundamentals, and following, the method that you put in place initially as an investor, whatever that asset class might be.
Well, it brings, social media and the news nowadays and the way and how quickly media can spread has brought a polarizing aspect to the marketplace that we haven't seen really in our history. And, Michael Jordan used to say, why segment any group in the marketplace? Conservatives' money spends no different than a liberal's dollar spends, and why separate that? And now, no matter what you say or do, it's become so public that social media naturally separates and segregates your product for you. So you have to be very careful with what you do and what you say, because that adage that I was talking about a while ago, that people are buying you up until your first 10 million. Now they're buying you no matter what. And if they don't believe you as the face of the company, or they don't support your beliefs, then you are segregating a demographic already. And so, I think that's interesting. But as we start seeing the public markets grow the way that they have and see overvaluations in them, one of the natural places that people have always moved is into precious metals like gold. That's kind of been one of the go-to, as Warren Buffett says, counter-correlated asset classes. But if you really look at Warren Buffett's portfolio, a lot of what he does that's counter-correlated to the market is real estate oriented. He's in mobile homes and the manufacturing of mobile homes. He is in real estate, and there's a number of aspects of that. So, walk me through kind of the pros and cons of gold as a counter-correlated asset class to some of the other alternatives, and specifically real estate, where we focus.
Yeah, I mean, precious metals has always been kind of that go-to hedge. I mean, traditionally, bonds have been a hedge. Although lately there's been a much higher correlation with stocks and bonds for a number of reasons, primarily interest rates. As you know, higher interest rates are going to deflate bond prices, and so that has not been the safe haven that it has been. A lot of people have rushed to precious metals, and as a safety net, um, that's not that that's certainly an option for people. The challenge, like anything with any investing, is timing, right? If you look last year, gold I think was 27, 28% year to date in 2025. It's up I think around 40%. So if you were smart enough to make that decision when the market was going gangbusters to allocate some money into precious metals at the end of 2023, you might have been okay. The big question is when. When do you buy and when do you sell? And so it goes back to what I like to call behavioral finance and investing, and that is, are you able to make smart decisions and counter correlate assets not only in an asset class but also from a timing standpoint? If you look at gold historically, though, let's go back and kind of look at what it offers. It is a hard asset that you sit on it, and you're hoping at some point to sell it for some sort of value in the future. Completely different than real estate, which, as you know, Ty, provides a number of different benefits, and historically over time has performed much better than gold if you look at some of the factors that make up real estate investing. So I would say gold is a portion of that portfolio. What I'm seeing from the advisor community as a large is less and less focus on promoting precious metals or gold as a counter-correlated asset, and getting into some sort of alternative investment is becoming much, much more mainstream. We recently saw the employer-sponsored retirement plan market, huge multi-trillion-dollar market, where alternatives have, and even gold, to be perfectly candid, has really been something that hasn't been available, because people look at it as, we need to offer something that's safe and secure for the participants in these plans because you might be acting as a fiduciary. In the past year, alternatives have become much more mainstream. Some of the largest providers, Empower, I think, is the second biggest record keeper in the country, has recently approved alternatives in their platform because they see the value that alternatives, and specifically real estate as an alternative asset class, can bring to investors, not only as a hedge, but as a great way to grow their portfolio in the future.
Well, you bring up an interesting point in talking about, well, we were talking about patience a while ago, and it takes a patient person in any of these markets to focus on when is the right time to buy and when is the right time to sell, and not getting overly excited about something that is said in the media, said on social media, or whatever the case may be. If you look over the last 100 years, so we were talking earlier, the S&P 500, if you put $100 in the S&P 500 100 years ago, today that $100 would be worth roughly $600,000. Okay. And if you did that in gold, the growth is not near as astronomical. That same $100 in gold is worth $9,000 roughly in gold. Okay. And so the unique thing about real estate, though, is there's different types of real estate, and people often, I've talked to, I don't know how many investors that say, I did great when I purchased my home, and I've settled my home and it's doubled in value right now over the last 8 years. Well, that's fantastic, but you live in your home. That is not an investment. It's a place to park money. It's like a savings account, but you've got to liquidate that savings account if you decide to exercise it, and you're going to have to move. And there's a lot of aspects that go into that. And so I'm not saying that it's not a portion of your wealth, but it should not be viewed as an investment. And the markets differentiate those two types of real estate. If you look at the median home price from 1925, or 100 years ago, the median home price was 11,600. And today it's just over $440,000. Okay. But if you look, and that's for a residential home that you're going to buy and live in. But if you look at real estate, and you brought this up a while ago, because there's other aspects of real estate investing that really make it unique. And I call those the four keys to success in investments. But it's number one, it's buying at a discount. So are you able to, and maybe you can buy your residential home at a discount. I remember the first home that I bought that my wife and I lived in, we bought a pre-foreclosure, and we bought it at a discount. So we bought some equity there. There's some equity at the buy-in. But you also want somebody that's in that property paying down equity for you as well, to see it as a true investment. So your equity is growing over time. You're also appreciating the value of the home or the value of the property is appreciating, is the number two aspect. The number three is during certain circumstances, you want to be able to see cash flow. Okay. And then the fourth one is the tax advantages that comes with real estate. And you're not always going to get all four of those. And in this market today, we're not seeing a lot of cash flow across the real estate sector, but we're seeing large growth in appreciation because of the inverse relation between supply and demand right now. We've got a huge inverse relationship between supply and demand. And so we're seeing Fortune 1000 companies relocate to the Dallas market right now. We had 3 years ago, 200,000 residential markets hit the marketplace in Dallas. 2 years ago, only 100. Last year, 55,000. And the new permits pulled for this year and moving forward is down further from that. But we're seeing the population grow by the thousands per day. So we've got a huge, huge supply problem right now, which creates an opportunity and specifically drives appreciation faster. And so $100 in investment real estate 100 years ago at the bottom of the Great Depression is worth 3.4 million today. Huge difference. Now, that's not saying that you should liquidate your stock portfolio and put it all in real estate, because we all know that real estate is extremely illiquid. But what we see happen is so many impatient investors pull money out of the stock market when it's at a bottom and they put it into real estate. And then they want to pull money out of real estate when the stock market is rising and put it into the stock market at that point. You want to, like Warren Buffett says, buy real estate and wait. But you want to buy equities at the bottom, sell equities at the top, and take some chips off the table. And that's where that patient comes into factor. So, Boone, why don't you step in too? One of the key aspects to driving value on real estate is adding a dollar of value or taking away a dollar of expense based on your management style. So, walk us through where that $100 in real estate can grow to $3.4 million in a 100-year period, because you're looking at aspects outside of just a paper investment and the valuation that the market creates. You're creating the valuation through the business strategy that you implement on the asset itself.
Well, yeah, I think there's a lot of aspects to take in there, and I'm going to start with going back to, you made a great point of seeing your personal house as not an investment vehicle. One of the things as you invest in real estate, as Ty was stating there, you've got a couple of different factors that you're looking for. You're looking for cash flow. You're looking for buy-in equity. Looking for appreciation. And then you're also looking for tax advantages. Whereas when you buy a home, you don't really see any of those other than the hope of appreciation. You're not going to get really any tax advantage from it, and you're certainly not going to get any cash flow from it. You're living into it, and when you look at an ROI perspective, you got to take into considerations how many times did your wife want to remodel the kitchen or a bathroom or anything else, and so you're putting a lot of money into a piece of real estate and not getting a dollar back on that. Whereas an investment vehicle, you go in and you renovate a bathroom and you increase your rents by $100, and so you're immediately making that money. You're making that money back and increasing the value of the property. You're getting massive tax breaks. A lot of the people in Washington are real estate holders. They create the tax code based around making it very attractive from a tax standpoint to own real estate. We do something called segregated depreciation. We go in and we do an economic study on every piece of real estate that we own, that allows us to break down the different aspects of that piece of real estate, from the foundation, the framing, the HVAC, all the plumbing and other mechanical and everything. And we get to whether that is a new piece of property or a piece of property that's been there for some time, we get to basically fast track that depreciation and get large tax breaks up front, where we hopefully, in best case scenarios, offset any type of income that, cash flow income that we get from that property. And if we sell it in the correct time frame, we get to, wipe out any taxable gain that we would have from that property as well. And so, when you take things like that from a tax perspective, and you take things from, going in and doing things on the property, like putting in economic flow toilets and economic windows where you get, energy tax credits and everything. There's a lot of things that you can do to really get increased ROI from that property that you're holding.
So, Brian, maybe walk me through a little bit too. We get a lot of questions around, how much cash flow am I going to get? How much am I going to see in a annual basis as far as cash flow on these real estate investments? And oftentimes, Boone just brought up a good point that we put that cash flow back into the property as well to create future opportunities for us and or to pay down debt. And de-lever the property, creating more equity for us. And so that goes back to really those four key factors. And what I find is that with real estate at any given time, we're focusing on two, maybe three of those. Walk me through what you're seeing and how you're communicating with investors around cash flow, and then the other three, equity and appreciation and tax advantages.
Yeah, I think it's important to look at what most investors think of when they think of real estate investments. And if you go out to any of the big providers, pick a company, a Blackstone, an Invesco, Franklin, all good companies. They have real estate funds. Most of those are REITs. REITs operate very differently than traditional private market real estate investments, as we all know, for a number of reasons. They are really going to be much more correlated to the market. They trade typically on a daily basis. Some have somewhat limited liquidity, but mostly trade on a daily basis. They don't reinvest back into the property from a value add standpoint. They have to pay out by law 90% of earnings. So that is not really a correlated asset. If you think about the advantages of real estate, you're not getting a counter-correlated asset typically in those types of vehicles. Private real estate, back to your point, Ty, you are able to take the cash flow, and that can either be paid out or it can be reinvested into the property to enhance the value. And obviously, the goal with private real estate is we want to see a value increase at the end. So if you buy a building for X amount of dollars, $100, the goal is to sell it for $200, $300 down the road. Well, how do you do that? Well, you take the money, the cash flow from rents and so forth, and you make CapEx. You make improvements in the properties, improvements in the portfolio, and increase your NOI. And then the goal is in a certain time period, might be 3 years, might be 5 years, might be a little bit longer, depending on the rate environment. You want to sell it for much more than you actually purchased it for. I'll tie that back. And again, I'm a little biased here, kind of thinking about public markets, but I'll tie that back to public markets. And typically, you've got something called the rule of 72. A lot of us have heard about that. And essentially, it's how much time does it take to double your money in traditional investments? And so you just take your rate of return divided by 72. If you go and look at the S&P over the past 30 years, it's done 9% or so. So you'll double your money in 5, 6, 7 years, kind of depending on the rate of return that you've got in it. Because you are able to look at both cash flow distributions reinvested and then look at the valuation and the appreciation of the property, the goal with private equity real estate is to accelerate that time period. We look to do a 2 times multiple in 4, 5, or 6 years. So accelerate that much quicker than you would typically be able to do in the public market. But the big difference here, and you mentioned this earlier, Ty, is the somewhat illiquid liquidity in real estate. And candidly, some people look at that and say, I want the liquidity. My question is always, if you do need the money in the next couple of years, that's certainly appropriate. And this particular investment may not be appropriate if you need to get access to it in the next 1, 2, or 3 years. In public markets, though, you have to look at something called behavioral finance. And behavioral finance is, yes, the S&P has done 9% over the past 30 years. What has the actual return for most investors been? And you just touched on it earlier. people tend to see the market going up and that sounds great and they put money in, the market's going down, they get scared and they take money out. So you're doing the exact opposite of what you should. You're buying high and you're selling low. So actual returns for your typical S&P investor is much less, call it 3, 4, 5%. Then you factor in inflation. Let's knock out the past 4 or 5 years that have been definitely an outlier, but most people are lucky to break even, where that illiquidity actually forces you into better behavioral decisions in real estate. And if you don't need access to the money for a period of time, you can actually prevent yourself from doing that and realize much higher returns and a much quicker multiple than you would in traditional public markets.
Brian,
So
do
you
you
bring
think
up,
that behavioral finance is built off fear, off of lack of education? What do you think are some of the things that build into a person's behavioral finance and their decision
Uh,
making?
Yeah, little bit of all of those, Boone. I mean, it's just look. I'm not immune to it. I can remember in the late 2000s, the stock, the Nvidia stock at that time was Cisco, and we saw it going gangbusters. A lot of people, myself included, allocated money into Cisco. We saw what happened. I learned that lesson once, and sometimes people do have to learn that lesson before they start to make more rational decisions. But the buy and hold strategy is a very difficult strategy for most people because of fear. I think fear is probably the biggest thing that they look at. And if you go back and look at some of these big market corrections, if you lose 20 or 30%, keep in mind, you don't have to earn back that 20 or 30% to break even, right? I mean, mathematically, if you lose 30%, you've got to now have a return of 42, 43, 44%, some odd, in order to just get back to break even. So there's a lot of fear that if we do have a market downturn, that I'm going to have to return much more to break even. But there's also a fear that's FOMC, as my wife says, fear of missing out. So when people see something going up, they don't want to miss the boat, and they feel like even though I might be getting in late, I want to get in better late than never.
So you both bring up a really good and interesting topic, and behavioral finance. That's almost going to have to be a topic that we create a full video around.
Yes.
We could spend 30 or 45 minutes alone on that, I think, and I think we're seeing it right now. We're seeing a very similar scenario to the late 1990s dot-com bust as it pertains to Wall Street right now, with the equities market, specifically the S&P 500, trading at north of 3 times book value, which it was in the I think it was at what, 3.3 or 3.5 in the late 90s dot-com bubble. And we're looking at a 4 to 5x book value right now in the marketplace. So what does that mean historically? And why is a 4 to 5x multiple on book value unsustainable for the foreseeable future?
Well, it goes back to what we talked about earlier. There's intrinsic and extrinsic value in these stock valuations, and the intrinsic value just doesn't support the type of valuations that you see. With some, you've got some extrinsic value outliers. Tesla might be one of those. Does it really justify, a 300 some odd multiple? Maybe if Musk can do what he says he can do, I mean, maybe it does support that. But I think historically, when you see those types of valuations, it's typically for certain types of companies, and obviously back, high tech stocks with AI and the information boom. There is a lot of extrinsic value in those types of securities, and so the key factor there is timing, right? Nothing can last forever, and you're right. Anytime you go back historically and look at the corrections, the '80s correction, the dot-com bubble, the housing bubble, this almost mirrors perfectly what we've seen from a price earnings increase and then immediately after a market correction. And so what we typically see most people do during good years is something called dollar cost averaging. It's just a way to make sure that you're purchasing securities or mutual funds or CITs at a good valuation over time. And so it's really very, very simple concept. If you want to invest $100, you do it $100 a month, and that way as the stock goes up and down, you're always buying at a good valuation, and over time you're building a portfolio. Well, that works in reverse as well, and I think we talked about it. What a lot of people are seeing now is they are taking some of these securities that they own, and it could be mutual funds, a lot of S&P 500 funds that they see as being very highly valued, and they are taking some of those chips off the table because Maybe I don't want to take all of it off the table. There's still value in the market over time, but let's do a reverse dollar cost average and take some of those chips off the table, set those aside, and put those in a counter correlated asset. That is becoming much, much more mainstream now than what we've seen even 5 or 10 years ago.
Well, I mean, I think we've seen um, both Jamie Dimon with JP and Goldman Sachs have warned somewhere between a I've seen 10 and 20 and even as high as 10 and 30% um, market correction coming. And if somebody is sitting here with a portfolio that they've set on through the significant growth that we've seen since 2008, there was a couple of corrections. We had the 2012 correction, we had another correction during or coming out of COVID. But by and large, we're up significantly since the 2008 subprime crisis. And so if you just look at your portfolio since then until now, and you took what was estimated to be a market correction off the table. You take 20% of your portfolio off the table. You're going to significantly limit the downside of that correction in your existing portfolio, and you're going to create an opportunity around the those chips that you take off the table and put in something like real estate. Because what we're going to see and what we're seeing already right now is a correction in real estate. Real estate prices have not gone down as much as they have in some of the past corrections that we've seen. But what we have seen is supply has halted. So demand is ever increasing. We're becoming a renter's nation, much like the UK. Our population is growing and the housing is diminishing. We're having less and less, the ratio of doors to needed units is growing by the day. And so there's going to be a huge opportunity in real estate over the next decade. We're going to continue to see rent increase. And even if rent doesn't increase, we're still going to have a huge supply and demand issue where people need a affordable place to lay their head at the end of the day. So you take 20% off the market, out of the financial market and put it into real estate. You've become illiquid, no doubt about it. But your opportunity for those dollars far outweighs what it does in the market right now if the market is facing a 10 to 20% correction. So how do you look at, the pressures of, okay, what's the market going to do over the next year or 2 years? Are we going to see the correction that everybody is saying, or are we not? What's real estate going to do? I think we know what real estate's going to do, but that decision also comes with an illiquidity factor. How do you take that into consideration?
Yeah, I think for most people, it depends on what they are using it for. I mean, if you're a pre-retiree and let's say you have money in an IRA, a traditional IRA, even an employer-sponsored retirement plan, that's money you hypothetically aren't going to use for 10, 20, 30, 50 years anyways. And if you are in traditional public markets, you're not getting the advantage of that illiquidity premium for those dollars. So you might as well take advantage of that when you can, unless there is a time frame where you do need the money in the next couple of years. And then the question would be, do you need all of it? For most people, it's not 100% allocation into real estate. They have a certain amount of money and you need to keep some of that liquid if you do have a liquid need at some point in the next couple of years. It's a portion of that, right, that would typically go into real estate. But it's a real simple formula. If you invested $100 into something and that grew to $200, don't sell 200, sell 100 of it. Go back to where you were. You've locked in the gains. You still have that money working for you, because the other big thing that most experts will say is the biggest returns in the markets are after the biggest downturns, right? It's
Yeah.
always lightest after the biggest darkness. You don't want to lose that. You don't want to miss that opportunity. So you still want to keep those core investments available to take advantage of those public market upswings. But now you have all of those gains that are going to work for you in an asset class that is typically counter correlated. And to your point, not immune, right? But if you look at a typical portfolio, there are two measures that you look at, financial terms. There's alpha and beta. Alpha basically is excess return over the market. Beta is volatility compared to the market. And a typical investor who adds a 5 to 10% sleeve of real estate is going to add about 1% alpha, and they're going to reduce their beta by about 1%. Most investors, most experts would say that's something that you should look at when you think about the volatility that we have experienced to some extent, but we're most certainly going to experience moving forward.
Yeah, okay. So yeah, on the beta side or the volatility, with real estate, we're not going to see that much volatility. Now there's an impatient factor, and that impatient grows, which is going to take me into my next point here in just a minute. But you see that volatility happening in the real estate sector, but if you have the right patience, because it is illiquid, it makes it a little bit I'm going to say it makes it a little bit more simple to set on that investment as opposed to when it's in the equities market where you can just make you can see the volatility going on and you can make an impulse decision. Oh, I need to go sell right now, which is the worst thing you can ever do. I mean, I've had, out of our 750 investors, I think we talk about this all the time, Brian, you and Boone and I, out of, in any business, name the business, 10% of your clients are going to take up 90% of your time. And that is exactly true in our business right now. We have about 10% of our investors. There's 60 to 70 of our investors that call weekly or monthly and they have the same concerns. Oh, everything's going crazy in the market. Why don't we just sell all of our assets right now? Well, that's a terrible idea. That's like looking at the equities market and seeing a crash and deciding to sell everything at that point. Why would you do that? That's when you double down and you take advantage of the opportunities that are coming. Because with my next point, the same impatient factors that take place in the marketplace take place in our lenders as well. And what we see is our lenders in the real estate sector start to freak out when the interest rates are all over the place and they don't know what to do. And so they just by nature start putting pressure on their borrowers to exit assets or to do something different than what they were doing because they don't know, the lender doesn't know what the best path forward is right now. The lender's not the operator. And so what ends up happening is in a market like what we're seeing right now, and when the real estate market starts to correct, lenders start losing out on the opportunity to create new loans and they start looking for a way to create those new loans or to create revenue. And so oftentimes your loan servicers are going to bring the best opportunities. And we've seen that right now. We've got a lender that wants out of a loan so bad that they're willing to take a 35% discount on their loan. And that gives us as an operator a huge opportunity. We've also got servicers that are coming to us saying that, hey, we've got a borrower that needs a little bit of equity on their asset, and that borrower is willing to just walk away from the asset. So oftentimes we can find our best deals by going to the loan servicers and the brokers during a market like this, because those are the ones that are losing the most revenue. If you look at CBRE, you look at Colliers, you look at the large brokers over the last 3 years, their revenue in the Dallas market alone, their revenue has gone from nine figures to low eight or high seven figures. Massive layoffs because they have not been able to cycle new deals because operators are not going out and getting new debt when debt is at really, really high rates. And so that creates opportunities for some creative finance deals to step in and assume a loan in place with massive equity because an operator is impatient and looking to walk away from an asset because they don't know what to do. So patience plays an aspect across this entire investment platform, whether you're in the equities market or whether you're in real estate, and you've got to be able to focus and look at what's in front of you, not what's happening right now. So
When
how do
you
you look at that, Boone, and say, okay, what we're doing right now is working, although there's a lot of chaos going on around us. How do we focus on what we're doing right now to take advantage of what tomorrow is going to bring?
Well, one thing I want to just really touch on is when you act on impulse or when someone acts on impulse, there's a loser in that deal every time. When someone is having to act so, so hastily or out of fear or whatever, and they want to act now, the person on the other side of that is typically in a I get to take advantage of you phase. They know you're acting off impulse. They know that you're acting off a time constraint and a want to do now type of attitude, and they get to take advantage of that. And so, typically how we like to operate, not typically how we always like to operate is, don't make decisions off of impulse and emotion. Make decisions off of good information. And, so I just wanted to touch on that and, let everybody know that if you act impulsively, whether it's in real estate, whether it's in the market, whether it's buying a car or anything else, if you act off impulse, you're typically going to get taken advantage of.
So, Brian, kind of walk us through how you see the market impacted by impulse decisions and how investors can benefit from having patience by moving out of the equities market at the right times, moving into counter-correlated investments, and really take advantages of those opportunities.
Yeah, I think the key is if anyone tries to time the market, it's a losing proposition. It's like going to Vegas. If you think you're going to beat Vegas on a consistent basis, think again. So the idea is to do this very strategically, and I talked a little bit earlier about strategically taking some of your chips off of the table, and you can basically look at your current portfolio. You might have a mix of stocks, you might have a mix of mutual funds, maybe some equities, maybe some bonds, but look at your original basis that you've put in there and determine how much those have grown. The ones that have grown more, obviously, are the ones that you may want to consider taking more of those chips off the table and then investing those in a counter correlated asset. So it's a very simple matter. Most platforms, if you use Fidelity Investments as an example, or if you have an account with Edward Jones, you can pull up your account online and very easily look at your original basis, look at the growth, and then make a decision at that point, how much of those gains do you want to actually take off the table? But I think, Ty, I'll just touch on something a little bit broader, and and Boone, you also talked about this, and that is not making impulsive decisions. I think one of the real advantages I mentioned earlier that a lot of investors do have, I'll say it's the easy button of investing in that REIT fund that might be publicly traded on one of those platforms. It's easy to hit a button. You've got an app on your phone and you can trade from XYZ fund to XYZ REIT. But keep in mind, the way most of those are going to work are, if you think about the large players that are out there in the marketplace, they have, let's say, a billion. If they want to start a real estate fund, they're probably going to have something like $1 billion that they want to play with. So if you go to JP Morgan or any of the big banks, that's probably the type of capital that they're going to ask for to start an investment fund. And then if you look at the total assets in those funds, they're typically going to grow to 30, 40, $50 million in assets. So what are those funds typically going to invest in? Well, purely based on the size, they're going to have to focus on large buildings. Think of that office building in downtown Manhattan, which is traded very efficiently, meaning it has a lot of eyes on it, right? The pricing of that is going to be pretty darn accurate compared to the market rate because you have a ton of eyes on it. There's a lot of comps in the area. Obviously, it's a big area. And so you're not going to be able to take advantage of some of those benefits, Ty, that you and Boone both talked about earlier, which is looking at properties that may be traded at a discount, maybe properties where we can come in and do an assumable loan. So we believe that investment thesis is accurate, but how that's actually implemented is something that really differs because for us and for a smaller company, we can look for those inefficiencies in the market. So we're not going to be focused on the $300 million office building in downtown Manhattan. We can look at opportunities in local markets and smaller towns. And Ty, at some point, we'll talk about kind of our thesis and what we focus on. But we have properties in college towns where there's a lot of growth, a lot of rent demand. We can look at properties in those specific markets that are inefficient by design, where we can buy them at a discount, make improvements, and see a much greater value play. If you really just want to oversimplify this, it's a small cap versus a large cap. And if you look at small cap performance historically, it's been the best performing asset class. If you look at real estate performance and you divide that by an asset class standpoint, it's the small caps that have outperformed the large caps as well.
That's where I think in those small caps, that's where, and in the playgrounds, if you will, that we play in, that's where you can make the most impact. Now, it oftentimes takes the most work And there's a human capital aspect of that and what has to go on. But it's also it's a long-term play. And I've got I've got a couple of investors that I get constant questions from, and it's the impatient people. So here's one I'm reading. So from October 13th, hey, can I get an update on XYZ real estate fund? On October 23rd, again, hey, what's the next update on the real estate fund? Then last week, how's everything going? Is there any new update? Then again this week already, what's going to be the next update on the real estate fund? And that's impatient focus. I tell investors all the time, they're, like, how I get the question, how quickly does it take for y'all to implement your business plan? And I can walk them through the business plan. Typically, it takes 24 to 30 months to implement the initial CapEx business plan and change the property. Then at the end of the 24 to 30 months, we stabilize the asset. That takes another 12 months typically. So we're talking 3 to 4 years before we've implemented our strategy to see the overall value proposition that we bring to an asset. And then investors start getting concerned after 9 or 12 months because they don't see the change. And so you've got to be able to sit back, and that's why most people are not successful in real estate. One of my very first partners ever, one of Boone and I, very first partner, we learned so much from this individual. I remember to this day, and I actually have lunch with him again this week. I remember to this day, it was about 10 years ago, he told me, this business will absolutely eat you up and spit you out without a heart and soul after you get done if you're not patient and strong. You have to be able to look at everything that's going on around you that's telling you do this, do this, do this, and stay the course. You get 24 months in, 30 months in on a business plan that along that way, you've been taking punches along the way and you've had to make little strategic changes. It takes an insane amount of patience to stay focused and stay on that path that you originally set out for and still execute through the business plan. When everybody else around says, pull the plug and let's sell, let's do this, let's do this, when that would be the worst decision that you can make. And so you've got to be able to sit back and really think clearly without making those impulse decisions and say, hey, we decided 3 years ago that we were going to buy this asset. We were going to push existing tenants out down to a certain threshold. We were going to implement a business strategy and capital expenditures and release the property back up, knowing that during that time frame and along that business plan, the value of the asset was going to start here and it was going to dip down for a period of time while you have vacancy. That's going to happen. And most people don't have the heart to take that on and step in the ring with Mike Tyson and keep going. And that's what we're doing here. And so that's why you find operators that jump in during a 2017, 2018, when all you've got to do is fog a mirror and you can get into real estate. And then all of a sudden everything changes and you start seeing one operator after another crash and cater and fall. But then on the flip side, you've got those large caps that you were talking about. And that's where when you transition from having a team that focuses on the value add proposition and you start shifting out of those secondary markets where you can really step in and have a big focus and a big impact, and you sit back and you just say, I'm going to buy something that's a little bit easier and it may cash flow today and it may cash flow indefinitely for the next 10 years, but you're not going to have the ability to step in and create that value proposition that has the potential to double money in a faster timeline. And so you start going from a 5-year investment period that has a little bit of a cyclical approach to it to a 12-year investment period because you're just going to cash flow at 2, 3, 4, 5% for 12 years and then sell it at a mediocre growth. And that's what a lot of those large REITs are doing. They're saying, look, here's this big, beautiful building. We're going to dump a bunch of money into that and then let it sit there and it's going to cash flow 2, 3, 4, 5% for the next 12 years. And then we're going to sell it at a little bit more than what we paid for it. And so that's kind of there's a big different approach there. So how does in this industry and in this investment class, how does, and I want to hear this from both of you, Boone and Brian, and I'll give my input on it as well. How does discipline beat timing in this type of an investment?
Well, I'll start with one person we've talked a little bit about today is Warren Buffett and his strategy. He has a saying, "Time in always beats timing the market." And I know Brian, you've touched on it a while ago on having a disciplined approach of I'll use your dollar cost averaging. That's a very disciplined approach. It's I have an investment thesis. I have a way I'm gonna put chips on, and I have a way I'm going to take chips off. And it's when you follow a strategy or thesis or anything else, that's having discipline. It's making d decisions based on data, not emotion. It's not trying to, as Brian you put it, it's not trying to Vegas the market or a deal or anything else. You're not gambling. You have a strategic approach and a way of saying, I know I can calculate based off making this decisions, what my average is going to be. And where when you start trying to time things and go off speculation, that's the chance it you can hit big. There are those small chances that you can hit big, but that's also when people lose everything and make poor bad decisions.
Yeah, Boone. I mean, the only thing I would add, agree with everything you said, is we've all heard radio ads for these day trader platforms that are out there, right? Pay us $100, come to a class all day, and you can make all this money. The stat is literally, I think your average day trader loses 99%, or 98 or 99%. I mean, the rate is exceptionally high. So, of course, when they do those ads, they only touch on the one or two people that got lucky, right? There's luck, and that works 1 or 2% of the time where you might get lucky and fall into something at the right time. But on average, your day traders are going to lose 98, 99% of the time. And that goes back to discipline and having that patience to ride the wave.
Yeah, so I think, with this, the big thing that we can take is, and this is what I tell, I was talking to a couple of guys that I was golfing with the other day, and they were like, we want to get into real estate. We've had a few rentals ourselves and ended up selling those because it took too much time and was, always getting bombarded with renovation calls. And I never knew when I was going to have to come replace a toilet or a water heater or whatever. And we want to be in real estate, but don't know how to do it. And I think, the best way to do it is finding a disciplined operator that's been in the business 20, 30 years, that has seen multiple market cycles, that has gone through multiple market cycles, that has managed assets through each of those market cycles in different types of asset classes, that has a very disciplined approach. And it's somebody that, it's almost like I played, and I go back to sports oftentimes. I played football in college, and I didn't get to college by not being a good athlete and understanding football. I understood, and I had a pretty high football IQ. It wasn't the biggest guy on the field, but I had a pretty high football IQ. But that didn't take away from the aspect that sometimes when I'm sitting there on the field implementing a strategy on the field, I don't see everything that's going on. And I have a coach that is on the sideline as well as a coach in the press box looking down on everything that's going on, saying, hey, remember, this is the business strategy. This is the football strategy that we said we were going to take into this game. We're deviating from that. Let's get back on path here so that we can execute and move forward. And oftentimes, and this is what I was talking about a while ago with those 10% of our investors that take 90% of our time, because they get in the weeds and they watch their portfolio and they see everything that's going on in the marketplace around them, and they start getting distracted, and they need us to step back in, and we are that patience for their portfolio. Real estate, just like anything, takes patience. And the pro and the con to real estate is it's illiquid. And that illiquidity creates an opportunity, because somebody might step in and say, hey, We've got a bad real estate market going on right now. Interest rates are through the roof. Inflation is through the roof, and tenants can't afford to pay rent anymore. We need to sell. Well, the great thing about real estate is you're not going to put it on the market and sell it right now. So it makes you sit back and say, whoa, hold on. Let's look at the business plan. The business plan was we were going to create some vacancy. We were going to renovate units. We were going to set aside some sort of reserve to renovate units a second and third time throughout our hold process. But that second and third time was an update, not a major renovation. Let's work through that business plan before we pull the trigger and sell while we've got a bunch of vacancy because the marketplace is going in chaotic directions around us. And so you can use that illiquidity as a way to sit back and force patience that oftentimes an individual may not have. And so, I think the focus here is sometimes we have to be disciplined enough to do those things that hurt right now, that are a little bit painful right now, to see the fruits of our spirit and the fruits of our labor tomorrow and 10 years from now. And that's ultimately at the end of the day what we're all doing this for. I got into this as well as most of our investors to create generational wealth, to leave something behind that we didn't start with. And I'm looking to impact a fourth generation, and you don't impact generations by making hasty decisions today. You've got to look at what you're doing and how you're making decisions and saying, okay, not only how does this impact me today, but how does this impact 4 generations from now? And when you can sit back and make decisions that way, sometimes it helps you make those more difficult decisions right now and make that hard decision to do something that's difficult today to create an opportunity tomorrow. So we'll leave it with that. Any last words on that, Boone or Brian?
No, I think that was well said. Kind of the topic of the day is be patient, learn to be disciplined, be patient, and make good decisions.
Completely agree.
Well, with that, we've got a topic now based on this one for our next video. So we will talk about behavioral finance next time and how we can implement some of those patient strategies in our day-to-day life, in business, and in the investments that we're making. And how can we look and say, what is it that we're doing right now that's going to impact us positively tomorrow, instead of what quick, easy decision can I make today? So we'll focus on behavioral finance next time, and really how the wealthy position their portfolios and move offensively instead of defensively. So with that, thank you guys for being on today. Again, we've got both Boone and myself, the founders of Lasater Capital. We've been in this business for, north of 20 years now. And been partners for north of 20 years now. And we've got Brian that has joined us as well, our managing director, and with FINRA licenses and financial licenses from a number of different avenues. And he brings all of his experience in the equities market and in the industry of finance, and brings that into our real estate industry and private equity, and helps benefit each of our investors, current investors and future investors, on how they can start taking some of those chips off the table and allocate that into counter-correlated investments that have some differentiating liquidity segments that will help build your portfolio for a better tomorrow. So thanks, everybody, and we'll see you next time.